The pursuit of financial independence and monumental wealth often leads aspiring traders and investors down well-trodden paths, filled with promises of rapid gains, complex algorithms, and the allure of constant market engagement. Yet, standing as a titan above this bustling arena is Warren Buffett, the Oracle of Omaha, whose unparalleled success has transformed Berkshire Hathaway from a struggling textile mill into a multi-billion-dollar conglomerate, delivering an average annual return of approximately 20% since 1965. His journey to becoming one of the wealthiest individuals in history wasn't paved with speculative gambles or adherence to fleeting market trends, but rather by a set of profound, often overlooked principles. This video unveils 7 unexpected rules from Warren Buffett that helped him achieve unprecedented wealth. Rules that are rarely discussed and even less frequently applied by the broader investment community, yet hold the key to building lasting prosperity. Rule 1. The power of no, the art of focus. In a world saturated with information, endless opportunities, and the constant hum of new, hot trends, true success, as Warren Buffett demonstrates, lies not in saying yes to everything, but in mastering the art of saying no to almost everything. This isn't merely a time management hack, it's a fundamental investment discipline that liberates one to concentrate solely on truly exceptional opportunities. The modern investor is bombarded daily by financial news, analyst reports, social media gurus, and an ever-expanding universe of asset classes, from traditional stocks and bonds to cryptocurrencies, NFTs, and exotic derivatives. Each new development screams for attention, promising the next big wave of wealth. However, Buffett's philosophy teaches us that succumbing to this noise is a direct path to mediocrity. He consciously and rigorously filters out the vast majority of propositions that do not align with his stringent, deeply considered criteria. This isn't about ignorance or missing out. It's about intelligent self-preservation and protecting one's most valuable assets: time, mental energy, and capital. By consistently rejecting the merely good or interesting, Buffett reserves his resources for the extraordinary. This deliberate refusal to engage with distractions allows for an unparalleled depth of analysis on the few opportunities that truly matter. It's a strategic move to avoid dilution of focus and to ensure that when an investment is made, it is done with conviction born from exhaustive due diligence. This principle forms the bedrock of his concentrated portfolio approach. Unlike many institutional and retail investors who aim for broad diversification across numerous companies and sectors, Buffett makes substantial, conviction-backed bets on a small number of businesses he profoundly understands. The conventional wisdom often preaches that broad diversification is the safest path, reducing risk by spreading capital thinly across many assets. While diversification has its merits in risk management, Buffett argues that excessive diversification, what he playfully calls diversification, can lead to diluted returns and a superficial understanding of one's holdings. If an investor owns 50 or 100 different stocks, it becomes virtually impossible to conduct the deep, fundamental analysis required to truly understand each business's intrinsic value, competitive advantages, and management quality. Instead, Buffett prefers to allocate significant portions of his capital to a select few companies where he possesses a proprietary understanding, a strong conviction in their long-term prospects, and a belief that they are trading below their intrinsic value. This concentrated approach demands a higher level of analytical rigor and patience, but it also offers the potential for significantly superior returns, as the successes of a few well-chosen investments are not offset by the average performance of many mediocre ones. It forces the investor to become an expert in their chosen fields, rather than a generalist with shallow knowledge across many. Practically, embracing the power of no means developing a clear, unwavering set of investment criteria and then ruthlessly adhering to them. For an individual investor, this translates into avoiding the shiny object syndrome, the temptation to jump into the latest trending stock or sector without adequate research, simply because everyone else is doing it. It means taking the time to truly understand a business before investing rather than relying on headlines or tips. It involves cultivating the discipline to step back, to resist the urge to constantly be doing something in the market. Instead of feeling compelled to invest in every perceived opportunity, an investor should view their capital as a precious resource, deployable only when truly exceptional conditions are met. This might mean long periods of inactivity, holding cash, and patiently waiting for the right pitch, as Buffett himself often does. It requires courage to swim against the tide of popular opinion, to ignore the fear of missing out, FOMO, and to trust one's own well-researched judgment. The focus gained from saying no allows for a deeper dive into the financials, competitive landscape, and management quality of potential investments, transforming an investor from a passive participant into an active, knowledgeable owner, critically assessing each opportunity against a high bar of excellence. Rule 2. Investing in yourself, the best investment. While much of the financial world fixates on asset allocation, market timing, and stock picking, Warren Buffett consistently champions a fundamentally different and often overlooked investment: investing in oneself. He emphatically states that the best investment you can make is in yourself. This isn't a platitude. It's a cornerstone of his philosophy, emphasizing personal growth, the acquisition of knowledge, and the continuous refinement of skills as the ultimate foundation for creating and sustaining wealth. Unlike financial assets, which can fluctuate wildly and are subject to market whims, the knowledge and skills you accumulate are enduring, portable, and appreciate over time in ways that compound exponentially. This personal capital cannot be taken away by market crashes, economic downturns, or geopolitical instability. It is the most resilient form of wealth an individual can possess. Buffett's perspective shifts the focus from external market forces to internal self-improvement, suggesting that the most powerful leverage an investor has is their own intellectual and personal development. Buffett famously likens knowledge to compound interest, underscoring its cumulative and ever-growing value. Just as compound interest allows initial capital to grow exponentially by earning returns on previously earned returns, knowledge compounds by building upon existing understanding, creating new insights, and enhancing one's capacity for complex problem solving. Buffett himself is a voracious reader, dedicating a significant portion of his day to absorbing information from books, annual reports, and various publications. He reads hundreds of pages daily, not merely for entertainment, but as a deliberate strategy to expand his circle of competence, a concept we will explore further and deepen his understanding of businesses, industries, and human behavior. This relentless pursuit of learning isn't confined to finance alone. It encompasses history, psychology, economics, and biographies, all of which contribute to a more holistic and nuanced worldview essential for astute decision-making. For the average investor, this translates into a commitment to lifelong learning, whether through reading, taking courses, attending seminars, or simply engaging with diverse ideas. It means actively seeking out information that challenges existing beliefs and broadens one's perspective, rather than passively consuming content that merely confirms biases. Beyond acquiring knowledge, investing in oneself also encompasses the development of critical skills. Buffett highlights the importance of improving communication skills, both written and verbal, as a direct enhancer of one's earning potential and influence. The ability to articulate complex ideas clearly, to persuade others, and to negotiate effectively are invaluable assets in any profession, including investing. Strong analytical thinking, the capacity to dissect information, identify key variables, and draw logical conclusions is equally crucial. This skill isn't innate. It's honed through practice, critical evaluation, and a willingness to challenge assumptions. Furthermore, understanding various industries and business models, even those outside one's direct investment focus, can provide a broader context and reveal interconnected patterns in the economy. For instance, comprehending the regulatory landscape of a particular sector or the technological advancements impacting another can offer crucial insights when evaluating a potential investment. These developed skills directly impact an investor's ability to identify profitable opportunities, assess risks accurately, and make sound, independent judgments, rather than relying on external advice or fleeting trends. Finally, a crucial yet often overlooked aspect of investing in oneself is the deliberate choice of one's environment and associates. Buffett famously advises working with people who are better than you because you'll drift in the direction of the people that you associate with. This extends beyond professional colleagues to one's social circle and even the content one consumes. Surrounding oneself with intelligent, disciplined, and ethically sound individuals creates a positive feedback loop, fostering an environment of continuous learning, mutual challenge, and shared growth. Conversely, associating with those who are reckless, short-sighted, or intellectually lazy can subtly erode one's own standards and judgment. This principle encourages a proactive approach to curating one's intellectual and social ecosystem, ensuring that one is constantly exposed to ideas and individuals that elevate rather than diminish one's potential. It's about selecting mentors, choosing collaborators, and even selecting the authors whose works one reads, all with the intention of enhancing one's personal and professional trajectory. Ultimately, investing in oneself is the ultimate long-term growth strategy, yielding dividends that compound not just financially but also intellectually and personally, forming an unbreakable foundation for enduring success. Rule 3. Circle of Competence. Know your limits. One of Warren Buffett's most profound and consistently applied rules is the concept of the circle of competence, knowing your limits and operating strictly within them. He famously stated, "What an investor needs is the ability to correctly evaluate selected businesses." Note the word selected. You don't have to be an expert on every company or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not important. Knowing its boundaries, however, is vital. This principle stands in stark contrast to the prevailing culture of know-it-all finance, where investors often feel pressured to have an opinion on every stock, every sector, and every market movement. In an era dominated by FOMO, the fear of missing out, investors are frequently tempted to pour capital into areas they barely understand, simply because those areas are generating buzz or experiencing rapid price appreciation. Buffett's principle acts as a stringent form of self-limitation, a protective barrier against costly errors born of ignorance and overconfidence. It's a humble acknowledgement that no one can be an expert in everything, and that true wisdom lies in understanding where one's expertise ends. The core of this rule is the conscious avoidance of the unknown. While many investors chase novelty, Buffett actively shuns investment opportunities that fall outside his domain of deep understanding. He isn't interested in industries that are overly complex, opaque, or require specialized technical knowledge that he doesn't possess. This isn't a criticism of those industries. It's a recognition of his own limitations. For example, during the frenzied dot-com boom of the late 1990s and early 2000s, when technology stocks soared to astronomical valuations, Buffett famously refused to invest in internet companies. His rationale was simple. He didn't understand how these businesses would generate sustainable profits in the long term, nor could he reliably value them. While many contemporaries mocked his old-fashioned approach, his decision proved prescient. When the dot-com bubble burst, wiping out trillions in market value, Berkshire Hathaway, by staying within its circle of competence, emerged largely unscathed, validating the wisdom of his self-imposed restraint. This example vividly illustrates how adhering to one's circle of competence prevents expensive mistakes that arise from venturing into unfamiliar territory. It's about playing only the games you know you can win, or at least understand the rules of. The circle of competence emphasizes depth of knowledge over breadth. Instead of acquiring a superficial understanding of many different areas, Buffett advocates for a profound, almost proprietary understanding of a few select businesses and industries. This deep knowledge acts as a formidable competitive advantage. When an investor truly understands the economics of a business, its competitive landscape, its management team, and its long-term prospects, They can make decisions with a level of conviction and clarity that is impossible for those operating on surface-level information. This depth allows for a more accurate assessment of intrinsic value, a clearer identification of economic moats, sustainable competitive advantages, and a greater resilience to market fluctuations. For instance, Buffett's long-standing investments in companies like Coca-Cola or American Express stemmed from his deep understanding of their brands, consumer loyalty, and robust business models. He wasn't relying on complex financial models or quarterly earnings forecasts. He was relying on a fundamental grasp of how these businesses created and sustained value over decades. This guarded knowledge allows him to act decisively when opportunities arise within his circle and to remain patiently on the sidelines when they do not. For an individual investor, identifying and staying within one's circle of competence requires honest self-assessment. It means asking, what do I truly understand? This might be the industry they work in, a consumer product they use daily, or a service they've researched extensively. It's about leveraging one's unique background, experience, and interests. If you're an engineer, perhaps you have an edge in evaluating certain tech companies. If you're a healthcare professional, perhaps medical device companies fall within your purview. The key is to be brutally honest about what you don't know and to resist the temptation to speculate in areas where you lack a fundamental understanding. This doesn't mean the circle is static. It can be expanded over time through dedicated learning and research, as highlighted in Rule 2. However, any expansion must be deliberate, gradual, and thoroughly grounded in new knowledge, not driven by fleeting market fads. By rigorously defining and respecting the boundaries of their competence, investors can significantly reduce risk, improve decision-making quality, and increase their probability of long-term success, transforming uncertainty into a source of advantage. Rule 4. Embracing simplicity. Counteracting complexity. In the intricate world of finance where jargon, complex models, and sophisticated strategies are often celebrated, Warren Buffett stands as a staunch advocate for simplicity. He often observes that business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective. This rule is a direct challenge to the prevailing notion that complexity equates to intelligence or superior performance. Instead, Buffett argues for investing in simple, understandable businesses, those whose operations, products, and revenue streams can be easily grasped by a reasonably intelligent person. This commitment to simplicity is not a sign of intellectual laziness. It is a profound recognition that complexity often obscures risks, makes accurate valuation difficult, and invites error. The financial industry, with its elaborate derivatives, convoluted corporate structures, and arcane accounting practices, frequently benefits from this complexity as it creates an aura of specialized knowledge that can intimidate outsiders. Buffett, however, cuts through this fog, seeking clarity and transparency above all else. The fundamental reason Buffett champions simplicity is that complexity frequently conceals risks. When a business model is overly intricate, involving numerous subsidiaries, complex financial engineering, or opaque revenue recognition methods, it becomes exceedingly difficult for even seasoned analysts to fully understand its true financial health and underlying risks. Such complexity can mask operational inefficiencies, hidden liabilities, or unsustainable growth strategies. Buffett's approach is to avoid businesses where the story is too convoluted or where he cannot articulate in simple terms how the company makes money and sustains its competitive position. He believes that if you cannot explain a business to a bright 10-year-old, you probably don't understand it well enough to invest in it. This adherence to simplicity acts as a powerful risk mitigation tool. By focusing on businesses that are straightforward with clear value propositions and predictable cash flows, he reduces the chances of encountering unpleasant surprises or unforeseen pitfalls that might be embedded within more complicated enterprises. It's a preference for clarity over obscurity, for transparency over opacity. Moreover, simple businesses often possess what Buffett famously calls economic moats, sustainable competitive advantages that protect their long-term profitability and market share. These moats are typically easier to identify and evaluate in straightforward businesses. For example, a strong brand like Coca-Cola, a dominant market share like American Express in its niche, or a cost advantage like certain utility companies are relatively simple concepts to grasp and assess. These are not complex financial instruments or intricate technological processes, but rather fundamental characteristics that allow a company to defend itself against competition and generate consistent returns. In contrast, businesses operating in rapidly changing technological landscapes, or those with highly speculative product pipelines, often lack such clear and enduring moats, making their long-term prospects much harder to predict. Buffett's focus on simple businesses with identifiable moats allows him to invest with a higher degree of confidence in their enduring value, rather than speculating on the success of complex, unproven ventures. He seeks out businesses where the path to continued profitability is clear, not convoluted. This rule embodies the keep it simple, stupid, KISS principle applied to investing. It encourages investors to resist the temptation to chase the latest, most sophisticated investment vehicles, or to feel inadequate if they don't understand every nuance of a cutting-edge industry. Instead, it directs them to concentrate on the fundamentals. What does the company do? How does it make money? Who are its customers? And what makes it special? For individual investors, this means favoring companies with business models that resonate with their everyday experience or that operate in industries they can easily understand. It might mean investing in consumer staples, well-established industrial firms, or local businesses with clear competitive advantages, rather than highly leveraged financial institutions or speculative biotech startups. It's about prioritizing clarity and robustness over perceived intellectual sophistication. By embracing simplicity, investors can avoid many of the pitfalls that trap those who are drawn to the allure of complexity, instead building a portfolio grounded in solid, understandable businesses that have a high probability of generating sustainable wealth over the long term. This approach fosters a deeper appreciation for fundamental value and a healthy skepticism towards anything that requires an overly complicated explanation. Rule 5. Emotional detachment, the psychological game. Warren Buffett consistently asserts that investing is far more a psychological game than an intellectual one. His most famous dictum, "Be fearful when others are greedy and greedy when others are fearful," encapsulates this profound insight into the behavioral aspect of markets. This rule highlights the critical importance of emotional discipline, a trait that sets successful long-term investors apart from the vast majority who fall prey to market sentiment. The stock market, in Buffett's view, acts as a manic-depressive partner named Mr. Market, who daily offers to buy or sell your shares at wildly fluctuating prices, sometimes euphoric and sometimes despondent. The intelligent investor's job is not to be dictated by Mr. Market's moods, but to take advantage of his irrationality. This requires an extraordinary level of emotional detachment and a steadfast commitment to independent thinking, even when the crowd is moving in the opposite direction with overwhelming force. The primary challenge in investing is to resist the powerful pull of the herd instinct. Most investors driven by primal emotions like fear and greed tend to follow the crowd, leading to predictable and often disastrous outcomes. When the market is soaring, fueled by optimism and speculative fervor, greed, individuals rush to buy, often at inflated prices, fearing they will miss out on further gains. This herd behavior creates asset bubbles. Conversely, when the market is in decline driven by panic and uncertainty, fear, investors rush to sell, often at depressed prices, fearing further losses. This fuels market crashes. Buffett's rule directly counteracts this destructive cycle. Being fearful when others are greedy means having the discipline to stand aside, or even sell, when asset prices are irrationally high and everyone is optimistic. Being greedy when others are fearful means having the courage to buy when asset prices are irrationally low and everyone else is panicking and selling. This contrarian stance is incredibly difficult to maintain because it requires going against deep-seated human tendencies and risking social disapproval or the feeling of being wrong in the short term. This principle delves deep into the realm of behavioral finance, a field that studies the psychological biases influencing financial decision-making. Buffett intuitively understood these biases long before the academic field gained prominence. He actively combats common pitfalls such as confirmation bias, seeking out information that confirms one's existing beliefs, recency bias, overemphasizing recent events, and the availability heuristic, overestimating the likelihood of events that are easily recalled. For instance, during a bull market, confirmation bias leads investors to only read articles praising the market's ascent, while recency bias makes them believe that the market will continue to rise indefinitely. When a downturn hits, the same biases lead to panic selling. Buffett's emotional detachment allows him to transcend these cognitive traps. He doesn't allow the immediate emotions of fear or euphoria to cloud his long-term analytical judgment. He focuses on the intrinsic value of businesses, viewing market price fluctuations as opportunities or warnings rather than indicators of fundamental shifts in value. He understands that the market is a voting machine in the short run, but a weighing machine in the long run. Maintaining independent thinking, even when the market is gripped by collective hysteria or irrational exuberance, is paramount. This requires a strong internal locus of control and a deep conviction in one's own analysis. It means being comfortable with being an outlier, with potentially looking foolish in the short term, and with having the patience to wait for one's thesis to play out over years, not weeks or months. Buffett doesn't look to the stock ticker for validation. He looks to the underlying business performance. He encourages investors to imagine they own a private business. Would they sell it simply because a hypothetical Mr. Market offered them a low price today, or would they focus on its long-term profitability? This owner-operator mindset fosters the emotional resilience needed to weather market storms and capitalize on the mispricings created by others' emotional reactions. By cultivating emotional detachment, investors can transform the market's irrationality from a source of danger into a wellspring of opportunity, buying valuable assets at bargain prices when fear reigns and avoiding overvalued assets when greed takes hold, thereby significantly enhancing their long-term investment returns. Rule 6. The 20-slot rule. Quality over quantity. Warren Buffett's 20-slot rule is a powerful yet rarely adopted challenge to the conventional wisdom of broad diversification. He posits, if you had a punch card with only 20 slots for investments in your entire lifetime, you would make decisions much more carefully. This thought experiment forces an investor to be incredibly selective and disciplined, prioritizing quality and deep conviction over the sheer number of holdings. In essence, it argues against the idea that more diversification automatically equals better results, suggesting instead that too much diversification can lead to what he calls diversification, diluting returns and scattering analytical capabilities across a multitude of mediocre assets. This rule encourages a concentrated portfolio approach where an investor makes significant bets on a very limited number of their absolute best ideas rather than spreading capital thinly across dozens or hundreds of companies. The prevailing dogma in modern finance often mandates wide diversification, sometimes suggesting that holding 50, 100, or even more stocks is the optimal way to manage risk. The rationale is that by owning many different assets, the poor performance of a few will be offset by the good performance of others, leading to an average, more stable return. While this approach has its place, especially for passive investors or those with limited time for research, Buffett argues that for an active, knowledgeable investor, this can be counterproductive. He contends that beyond a certain point, adding more investments does not meaningfully reduce risk, but instead guarantees average results. If an investor truly understands a business, has a high conviction in its long-term prospects, and believes it is undervalued, why would they dilute that potential return by allocating capital to dozens of other companies they understand less well or have less conviction in? Buffett famously states that 3 excellent, deeply understood companies are far superior to 100 mediocre ones. The act of diversification essentially ensures that you don't make outsized returns, as your winners are constantly held back by your average performers. It's a strategy of settling for average, rather than striving for excellence. This rule demands a high level of conviction in each investment. When an investor commits a significant portion of their capital to a limited number of companies, they are forced to conduct incredibly thorough due diligence. Every investment decision becomes critical, as there are no throwaway slots. This intensifies the analytical process, pushing the investor to gain a truly proprietary understanding of each business, its competitive advantages, management quality, financial health, and long-term industry trends. This deep conviction, born from rigorous analysis, is what allows Buffett to hold his investments for decades, weathering short-term market fluctuations and remaining steadfast in his belief in the underlying business. It's the opposite of speculative trading, where positions are often taken based on fleeting news or technical indicators. For Buffett, each punch on the card represents a profound commitment, akin to buying an entire private business rather than just a few shares. This focused approach means that when a truly exceptional opportunity arises, he can allocate substantial capital to it, maximizing the potential returns from his best ideas. An often unacknowledged implication of the 20-slot rule, particularly for those managing large pools of capital, is that size is the enemy of performance. While not explicitly part of the initial rule, it's a natural extension of concentrated investing. For smaller investors, it's easier to find numerous high-quality, undervalued opportunities that can move the needle on their portfolios. However, as capital grows into the billions, finding businesses that are large enough to absorb significant investment without moving the market price and yet still offer exceptional growth prospects becomes increasingly challenging. Buffett himself has lamented this phenomenon, acknowledging that his firm's sheer size makes it harder to achieve the same percentage returns he did in his earlier, smaller partnerships. This unexpected challenge underscores that the benefits of concentrated investing are often more accessible to individual investors or smaller funds, who have a wider universe of potential opportunities to choose from. It encourages smaller investors to fully embrace their advantage of agility and focus, making high-conviction bets on businesses that might be too small to interest institutional giants, yet offer immense potential for growth and returns. By adhering to the 20-slot rule, investors are compelled to elevate the quality of their decision-making, transforming their portfolio from a collection of average holdings into a concentrated powerhouse of their absolute best ideas. Rule 7. Business Owner's Mindset, Beyond Stock Prices. Perhaps the most fundamental and transformative of Warren Buffett's unexpected rules is the admonition to invest in stocks as if you were buying the entire business. His preferred holding period? Forever. This principle radically shifts the focus from the ephemeral fluctuations of stock prices and quarterly earnings reports to the enduring value and operational realities of the underlying enterprise. It's a profound departure from the mindset of a trader, who often views stocks as mere pieces of paper to be bought and sold based on short-term price movements or technical indicators. Instead, Buffett encourages investors to adopt the perspective of a true business owner, deeply concerned with the quality of the business, its long-term economic prospects, and the competence of its management, rather than the daily whims of the stock market. This owner's mindset directly translates into ignoring short-term market fluctuations. While traders and many investors are glued to daily stock prices reacting to every tick, Buffett views the stock market as a mechanism that occasionally offers him the chance to buy shares of excellent businesses at attractive prices, or to sell them at absurdly high prices. He doesn't let the market's irrationality dictate his investment decisions. Instead, he focuses on the intrinsic value of the company, which is derived from its future earnings power, its competitive advantages, and the quality of its assets. A company's intrinsic value doesn't change significantly from day to day, even if its stock price does. By adopting this long-term perspective, an investor can avoid the emotional traps of panic selling during downturns or speculative buying during bubbles. They understand that short-term market noise is just that, noise, and has little bearing on the fundamental health or long-term potential of a well-run business. This approach requires immense patience and a steadfast belief in one's own analysis, allowing the underlying business to compound its value over years, irrespective of transient market moods. Central to this rule is a rigorous commitment to fundamental analysis. Unlike traders who might rely on chart patterns or news headlines, Buffett delves deep into the core of a business. He meticulously studies its industry dynamics, competitive landscape, financial statements, balance sheets, income statements, cash flow statements, and, crucially, its economic moats. These moats are the sustainable competitive advantages that protect a company's profits from rivals, such as strong brands, patent protection, network effects, cost advantages, or high switching costs for customers. Understanding these moats is paramount because they are the foundation of a business's long-term durability and pricing power. He also pays close attention to the quality and integrity of the management team, viewing them as stewards of the shareholders' capital. This comprehensive understanding allows him to form a clear, independent judgment of a company's true worth, enabling him to buy when the market offers the shares at a discount to this intrinsic value and hold for the long haul. His process is akin to evaluating a private company acquisition, where every detail matters and the intention is to own it indefinitely. A classic example illustrating the power of this owner's mindset is Buffett's investment in Coca-Cola. He first began buying shares in Coca-Cola in 1988, investing approximately $1.3 billion. At the time, many viewed it as a mature company with limited growth potential. However, Buffett saw a global brand with an unparalleled economic moat, a simple and universally appealing product, and immense pricing power managed by a competent team. He wasn't focused on quarterly earnings or short-term stock movements. He was focused on the enduring power of the Coca-Cola brand and its potential to generate cash flow for decades. Today, that initial $1.3 billion investment is worth over $24.8 billion and generates approximately $700 million per year in dividends alone. This staggering return, achieved over more than 3 decades, is a testament to the power of thinking like a business owner, ignoring the market's daily chatter, and focusing on the long-term compounding of a truly great business. It shows that true wealth is built not through frequent trading, but through patient, informed ownership of high-quality assets. In summary, Warren Buffett's path to becoming one of the world's wealthiest individuals wasn't paved with complex strategies or market timing, but with a set of profound, often counterintuitive principles. We've explored these 7 unexpected rules: the decisive power of saying no to maintain focus and discipline, the foundational importance of investing in yourself through continuous learning and skill development, the critical wisdom of knowing and operating within your circle of competence, the clarity and risk reduction achieved by embracing simplicity in business models, the essential psychological discipline of emotional detachment to counteract market irrationality, the 20-slot rule emphasizing quality and conviction over excessive diversification, and finally, the transformative power of adopting a true business owner's mindset, focusing on long-term value over short-term price fluctuations. These aren't quick fixes or speculative gambits. They are timeless tenets that demand discipline, patience, and a deep understanding of both business and human psychology. We encourage you to reflect on your own investment strategies and consider how integrating these principles could reshape your approach to building lasting wealth. True financial success, as demonstrated by the Oracle of Omaha, is not found in chasing the latest trend or succumbing to market noise, but in a disciplined, patient, and fundamentally sound approach to investing. The path to millions may not be what most imagine, but Buffett's unexpected rules offer a time-tested, proven route. While Buffett's principles guide us towards enduring wealth by understanding the fundamental value of businesses, it's also true that understanding the historical context of markets can provide invaluable perspective. For those who seek to deepen their appreciation for the historical tapestry of financial markets and learn from the triumphs and follies of past eras, we highly recommend 50 Years in Wall Street. This remarkable illustrated memoir by Henry Clews offers a vivid journey through 5 decades of Wall Street history, from the tumultuous panic of 1857 through the opulent Gilded Age. It's a treasure trove of insights filled with captivating stories of legendary financiers, daring market manipulations, and the timeless human dramas that play out in the financial arena. Understanding these historical cycles and the characters who shaped them provides a crucial backdrop to today's market dynamics, reinforcing the idea that while technology changes, human nature and market principles often remain constant. Just as Buffett learns from history, you can gain a unique perspective on the forces that have shaped financial markets for generations. Find the link to 50 Years in Wall Street in the description below to explore these rich historical accounts and deepen your understanding of the financial world's enduring lessons.